So the bad news is you get second string. And so what I'd like to do is explain to you why it is that R-CALF USA seems to be involved in a lot of litigation right now. We start with the name of our organization, the Ranchers-Cattlemen Action Legal Fund, United Stockgrowers of America. That should give a little hint that we may be involved in legal action. But if we look over the course of the past 50 or 60 years, there's been farm organizations and commodity groups that have been out lobbying Congress hard in order to improve the condition for U.S. farmers and ranchers. They've been doing it for 50 years. We came on board, the 20th anniversary, 20 years ago. We came on board and said, you know what? They haven't done the job right. We've got to do it better. We're going to be more aggressive, and we're going to get the job done. So we followed the same conventional lobbying techniques that have been applied to this industry for well over 50 years and haven't accomplished what it is we set out to accomplish, to provide more opportunities, not less, for aspiring farmers and ranchers to enter the industry, and for those of you who are currently operating to be profitable. That hasn't happened. And so we decided we need to do something a little different. Doing things a little more aggressive, but following the same lobbying techniques has not resulted in the outcome we wanted. And a good example of that is, let's look at our sister industry, the hog industry. In August of 2017, the U.S. Department of Agriculture came out with the long-awaited hog status report. And they said that from 1990, the beginning of this graph, to 2012, we see a decline in the number of hog producers. So in 1990, we had about 268,000 hog producers. And then over the course of till 2012, we wiped out 75% of them. So how many of you recall the hog industry jumping up and down and saying, wait a minute, this isn't what we bought into. This isn't good for rural America. What we are doing is we're eliminating producers. Well, what we were doing, we were following the policy dictates of the multinational meat packers who set out to vertically integrate our sister hog industry as they had already accomplished in the poultry industry. And what they figured out was 68,000 farmers were a lot easier to manage in the supply chain than 268,000. So they eliminated 75% of all of those pesky farmers so that they could capture the benefits of the very profitable hog industry. And we, as the United States of America, have created the new American farmer. Meet Wan Long from communist China. He's the largest hog producer in the United States of America. He's the CEO of Smithfield Farms. Wan Long's salary in 2017 was just a little bit higher than mine. His was $291 million. That's not what we set out to do for the last 50 years. That's not why we've been joining farm organizations. What we have been doing has not been working, so we needed a new strategy, and I want to talk about that with you this afternoon. But before I do, I want to set the stage for what's happening to our industry. And we can see in this chart here from 1990, the same time we lost 68,000, 75% of all the hog operations, we see that we have shrunk the number of participants in our industry. We were around NAFTA where the graph kind of levels out. During NAFTA, there were high expectations that we were going to increase market access, therefore provide more opportunities for U.S. cattle producers. But instead, what we saw is we saw a drastic decline in the number of ranches in this country. There was a mass exodus for the past 25 years, and we've lost over 187,000 cattle producers just since we entered this NAFTA agreement that was supposed to provide us with more profitability and more opportunities. It didn't happen. Our industry is shrinking and shrinking at an alarming rate in terms of the number of producers. And then we look at the factory, our mother cow herd. Our mother cow herd in 1994, in the middle of this graph, is significantly less than it was when we had a peak in 1975. So we had over 45 million mother cows in 1975. 1994, we were recovering from a reduction prior to that, and the expectations were for a couple years we were going to build and strengthen the U.S. cattle industry, because by opening the markets in Canada and Mexico, we were going to expand our market access, we were going to sell more beef, we needed more cattle, and that did not happen. Instead, 2 years after NAFTA was implemented in 1994 and 1996, we began the longest liquidation phase in the history of our industry. It lasted 16 years, and by 2014, our mother cow herd had hit the smallest level in over 7 decades. And even today, because the industry will tell you, well, we don't need all those mother cows anymore. We're producing more beef on the hoof than ever before. Our carcass weights are heavier. We're simply more efficient today, just like the hog industry was when they eliminated 75% of the producers, and they're producing more pork today than they were then. So they argue efficiency, but even today, with a growing population in the 3 countries, nevertheless, we hit the 70-year low just a few years ago, 2014, and even today, our total cow numbers are 7 million head smaller than they were in 1994, and our mother cow herd is 3 million head smaller. We're shrinking in the number of participants, we're shrinking in terms of the size of our factory, and then we look at you, cow-calf producers, who are selling your cattle, and your market, the buyer for your cattle, are the feedlots. So we look at the number of feedlots during the course of the North American Free Trade Agreement, and we see the blue graph beginning in 1996 every year through 2018. We see that there is a precipitous decline in the number of feedlots in this country. The blue part of that graph represents the small farmer feeders with capacities of less than 1,000 head. The red margin represents the larger feedlots, to the very, very large feedlots. You can see throughout this historical time period that we have lost a significant number of farmer feeders. We've lost over 74,000 of them, representing a 75% loss in the markets that were available to you to purchase your lighter weight feeder calves. So how many of you think, as you're sitting in the auction yards waiting for your cattle to be run over the scales, that the competition might be a little bit reduced when there's 75% fewer farmer feeders in the stands bidding for your cattle? Our industry has shrunk in terms of the number of participants, shrunk in terms of the size of our production capacity, our factory, and our markets are shrinking and shrinking fast. And we look at USDA data to say, well, how profitable is the cattle feeding sector in the United States? So we go back 19 years to January of 2000 using USDA data, and we see on this graph profits and losses. Months in which the feeders have been earning profits, months during which the feeders have lost, and in some instances, made horrendous losses. You can see intuitively that there are more losses than profits over this entire period from January 2000 all the way up till June of 2019. In fact, based on USDA data, the return to cattle feeding in the United States of America, on average, has been a negative $19.63 per head per month for 19 years. Well, that explains why we've lost so many farmer feeders, doesn't it? But if USDA data is true, if this is accurate, why in the world do we have any cattle feeders left at all in the United States if the profitability for that industry has been a negative on average for every month for the past 19 years? That's the issue that we're attempting to address when addressing consolidation. That's the issue we were attempting to address when we pushed for the rules with which to implement the Packers and Stockyards Act. As Dr. Moss talked about earlier, the Packers and Stockyards Act has never been fully implemented, not properly enforced. That act was designed to prevent the conduct of the meat packers that was conduct that inured to being unfair, deceptive, or unjustly discriminatory. In other words, that act was designed to protect you, the independent producer, from packer conduct that was unfair, deceptive, or unjustly discriminatory. And the act also prohibited the meat packers from granting undue preferences or advantages to some feedlots, but not to others. Well, if there are sweetheart deals going on with some of the largest feedlots it is quite possible that's the explanation for why we have a huge loss in the independent farmer feeders who likely don't have sweetheart contracts, and yet we see the larger, much larger feedlots in the United States growing, perhaps because they are receiving contracts that are not available to all. Undue preferences granted to some feedlots and not to others. If that is going on, as we suspect it is, that will account for the losses that we've experienced. Now, the USDA data, in addition to tracking the return to cattle feeding, also tracks the average cost per bred cow for you U.S. cattle producers, cow-calf producers. So we go back here to 1987, and the black line, of course, represents 0 returns per bred cow per year. And we see that in the months from 87 to 94, I don't have a pointer, but in 1994, right here is when we entered the North American Free Trade Agreement. So for the years leading up to the North American Free Trade Agreement, the average return per bred cow per year for U.S. cattle producers was $50 per bred cow. For 7 years, that was the average. And then we entered into the North American Free Trade Agreement with full expectations that we're going to increase market opportunities for us and increase our profitability and encourage younger people to enter our industry. And what happened? Returns per bred cow began to fall significantly. And then we saw a resurrection of the returns in the middle of the graph. You see, suddenly we have spikes. What happened there? That was the anomaly. That's when Canada detected BSE in their native cattle herd, and the United States closed its border to live imported cattle for over 2 years, and the industry has told you how damaging that BSE outbreak was to you. But look what happened to your average returns on a national basis based on USDA data. It's the first time in history your average return increased to over $100 per bred cow per year. And then, when the border was reopened to these imported cattle, we saw again your profits, your returns fall. And then we hit the years 2014 and 15, where you had the highest nominal prices in history for your calves. George just talked about the $300 calf prices. And then we subsided after that. So for the 7 years leading up to NAFTA, the average return per bred cow was $50 per year per bred cow. And then for the 25 years following NAFTA, when you were supposed to have more opportunities, more market access, your returns fell to $37 per bred cow. Congratulations. We entered this agreement to build our industry, and instead we reduced our independent producers' profitability. So if we look at, well, what happened all through this period, because this was also the period where we were implementing country of origin labeling. 2002 is when Congress passed the country of origin labeling law, but it took over 7 years because the meat packers fought back, reorganized, prevented USDA from promulgating the rules to implement that for beef and for meat. And so we went until 2009 with no country of origin labeling. So for the 13 years leading up to country of origin labeling, your average return per bred cow was about $15 per bred cow per year. And then in 2009, we partially implemented country of origin labeling. Let me explain. Country of origin labeling had 2 facets to it. First, what it did is it required all imported beef products coming into the border, going through U.S. borders, U.S. Customs and Border Protection. That meat had to retain its foreign label through retail sale, meaning all the way to the consumer. It was the 2002 country of origin labeling law that required the proper labeling of imported meat. That happened in 2009. And then, from 2009 to 2013, when there was a change in the country of origin labeling law, the returns to you increased to over $32 per bred cow per year. For those 4 years, we had partial implementation of COOL. Then in 2013, in May, we had full implementation of COOL, because that's when COOL accurately distinguished the beef produced from your USA cattle versus beef produced from foreign cattle, Canada and Mexico, slaughtered in the United States, where all of that beef is eligible for a product of USA label. So that happened in 2013, went through 2015. During the period that country of origin labeling was in full effect, your average return per bred cow per year jumped to $282. And then, though we've reached a higher plateau with cattle prices, following the 15, repeal of country of origin labeling, your returns have now fallen to $100 per bred cow per year on average. So there's a historical look at the profitability of cow-calf producers on a national average. Of course, this varies from south to north, east to west. But here's the important graph, because this is your cattle industry. This is your cattle industry. It's your cattle industry from July of 2009, right after country of origin labeling was passed. And the red represents your fed cattle prices, 1,300-pound steer prices on a monthly basis. And the blue represents the price that consumers are willing to pay for beef. So after country of origin labeling was partially implemented in 2009, we saw our fed cattle prices start to ratchet upwards. And we saw retail beef prices follow quickly. In fact, in synchrony with the fed cattle prices. And then you can see the little dip as we were ratcheting upward. There's a dip in the middle of the graph. And then suddenly we jumped to the highest nominal levels in history. And then our prices began to collapse in 2015. But what happened to retail prices? Retail prices continue to remain strong throughout the period. Your prices today are about where they were 8 years ago. Retail beef prices are up where they were when you were selling fat cattle for $160 and you were selling calves for about $250. That's where retail prices are today. So what does this graph, the picture of your industry, tell you? Now your checkoff dollar says it shows us we have accomplished exactly what we set out to do. We set out to increase demand, and we did. From 2012 to 2018, we increased beef demand by 15%. So congratulations for all the investments you've made with your checkoff dollars. You have been rewarded for increasing your demand by 15% with 5% lower prices. Congratulations. So does this graph tell you that the checkoff is doing exactly what it set out to do? No. What does this graph tell you? It tells you that somebody in this beef supply chain, this multi-segmented live cattle and beef supply chain, somebody in this industry is making a lot of money, and it ain't you. Isn't that what this tells you? That the spread between your fed cattle prices and consumer prices have never been higher. So I go back to the point, we have to do something different. Conventional lobbying techniques have not worked. We started out during that anomaly period in 2003 when BSE was first detected in Canada. And RCAF filed its litigation. We call that RCAF 1. We immediately won an injunction because we caught USDA allowing importers to bring in processed beef and ground beef in contradiction to the law. USDA folded, didn't even contest that. We won that injunction hand down. We stopped USDA from allowing that product into the United States until they first went through a rulemaking process. And then in RCAF 2, 2005, is when USDA wanted to reopen the border to younger animals under 30 months of age, even at the time that Canada was still experiencing multiple outbreaks of BSE. We filed and won an injunction in 2005 under RCAF 2. Then later in RCAF 3 in 2008, they wanted to reopen the border to even older animals. At the time when Canada was still detecting BSE. This was a time when your returns per bred cow were at that time the highest in history, and for good reason. It's because you produced the best beef in the world under the best of conditions, and consumers knew it, and beef demand continued to remain strong. And because we shut off a very relatively small volume of imports that the packers were using as a direct substitute for your beef, with the exit of that product from the marketplace, we unleashed the competitive forces in the marketplace, and you began to see some of a more profitable period. So then we get into the beef checkoff program, and David Maraskin, our lead counsel in the checkoff case, is going to talk to us later. But for the beef checkoff program, for 20 years, we've been trying to effect reforms using conventional lobbying techniques. We went to Congress. We asked Congress to write new legislation to reform the law. We went to the USDA. We asked USDA to reform the law. We said, we need three things. Number one, you have to separate the Federation of State Beef Councils from the National Cattlemen's Beef Association, because no lobbying group should ever be receiving a recipient of your mandatory checkoff dollars. So we wanted a clear separation of NCBA from the Federation, no lobbying group to receive funds, And very, very importantly, if you're going to contribute through a mandatory tax the largest share of the $80 million pie, why is it that you cannot promote and market your beef? Beef that is born, raised, and harvested in the United States of America. USDA doesn't allow you to do it. The Checkoff program doesn't allow you to do it. These were the three reforms we tried to achieve for 20 years, and we ran into a brick wall. So we filed, and as Tracy Hunt told you, your Checkoff dollars are contributing to this global roundtable for sustainable beef, which is facilitating the capture of the live cattle market by the marketing outlets. And so we then deployed a new strategy, litigation. We filed a lawsuit, and we said our argument was it was unconstitutional for the U.S. Department of Agriculture to compel producers to subsidize the private speech of private corporations, particularly when the producers disagreed with the speech. The private corporations, of course, are telling consumers, eat beef. Doesn't matter if it came from Montana, Manitoba, or Mazatlan, beef is beef. Just eat more beef and you'll be fine. Well, that's not what is in the interest of independent U.S. cattle producers. You want consumers to seek out the USA product, and you should be able to promote that with your mandatory dollars. And so that was the other change that we attempted to get. So we filed litigation. We won an injunction in the state of Montana, which was the test case. David Maraskin will talk about that. But the injunction applies there, and now we've expanded the case to include 15 more states. And so the marketing committee of RCAF USA back in 2018 said, we've got to show someone what's happening in this industry. Can we graph and illustrate exactly what's happened in the industry? So here's a graph of daily data running from 2013 all the way to mid-2018. And we see during this period prior to the high nominal prices, the peak of this chart, you can see as our cattle prices were increasing, the blue represents the cattle futures prices on a daily basis. The orange represents fed cattle prices, and then the yellow or gray are your select and choice wholesale beef prices. So you can see from 2013 up through the early 2015, there was a close convergence of cattle futures prices, cattle prices, and wholesale box beef prices. And then there was this departure. Your cattle prices collapsed, and yet we saw the wholesale beef prices continue to remain relatively strong as compared to your cattle prices, and we began seeing the widest margins in history. So we filed a request for investigation with the Commodity Futures Trading Commission, and this is some of the evidence that we have produced to demonstrate to everyone in the industry that our markets are broken, that there is something wrong, that the meat packers are earning record profits, and this is the CME groups telling us how much those profits have been, what the gross margins are to U.S. meat packers. The gray area in the middle of the graph represents the 10-year average, so that's around $200 per head gross margin for slaughtering cattle. But all of the lines above that, and particularly the red is 2019, this is on a monthly basis. You can see in 2017, the meat packers had margins of over $500 a head. And then in the red, we're now up well over $300 a head based on CME group data. So what this shows us is you go back to the graph that I said was a picture of your industry, the individuals who's making this windfall profits in the industry, and that individual is not you. Well, we see that the meat packer margins have increased considerably during that period. So we have this phenomenon going on too. We have feeder calf prices that are relatively higher than before, even though they've collapsed after 2015. But even today, at depressed prices, they're higher than they were, say, 10, 15 years ago. And then we have the fed cattle prices that have been seriously depressed through the period. So what's happened in our industry, what this graph shows you, is the difference between the value of a lighter weight feeder calf and the value of the fed animal finally sold to the meat packer. So early back in the 2000s, it was about a $25 differential. You would expect that, for example, if the fed animal was worth $100 future expectation, then the feeder calf would be worth $125. That's about where we were back in the early 2000s. And then we see this spike here where there was a significant increase in the value of feeder calf prices. The spread grew considerably, but the trend has been upwards. And so today, for that same expectation of a $100 fed animal, which is below the cost of production, by the way, but just for calculation purposes, it makes it easy. So if you have a $100 expectation for the sale of the fed animal, then you would expect those calves to be selling for about $55. So a significant increase for who? When the value of the feeder calf increases relatively, and when the value of the fed animal is depressed, somebody's getting squeezed in the middle. Who is that? It's those 74,000 farmer feeders that went out of business. It was the feeding sector. And so what has been happening here in recent years is we have been squeezing the profitability out of the feeding sector, thereby reducing the number of marketing outlets available to you cow-calf producers, and as a result there is less competition and you will continue to experience lower prices because you now have far fewer buyers for your cattle. Your industry is being concentrated even below the meat packer level right now. And so what's really at risk here? As we continue, and these are trends, this isn't an anomaly where we've suddenly had a slight decline in the number of cattle producers. Instead, these are trends, it's a downward trend, and the risk we take is the potential to lose the competitive marketing channels in our industry. What that means is, as you continually lose the opportunity to sell to thousands of independent cattle feeders, if you lose our local auction yards, if you lose the practice whereby the meat packers are still, in some instances, coming out to feed yards and making bids, or at least picking up the phone, when that's gone, folks, game over. The poultry industry learned this. The hog industry learned this. If you do not maintain the infrastructure to support a robust competitive marketplace, game over, and you never get it back. And that's why this is urgent. And so we must aggressively, as Dr. Diana Moss talked about, we must aggressively enforce our antitrust laws. And as you'll hear later this afternoon, we'll be talking detail of what we're doing to accomplish that. And we must preserve competition in our industry. Otherwise, we will not have young people showing up at our 21st RCAF USA convention. So let's talk a little bit about trade. And I want to go back to another sister industry, and somebody needs to be keeping track of my time. So you tell me when I got to stop. Because I don't have an Indian, I just stop when I run out of time. So our sister industry, the sheep industry. And now RCAF, we represent the sheep industry too. So the question we must ask ourselves is, can imports hurt a domestic industry? And all we need to do is look at our sister sheep industry, which is very comparable and similar to our industry. They're both ruminant animals. Our marketing structures are very similar. And so we go back to 1980, and the blue graph represents the production of lamb and mutton in the United States. And then the red line on the top there represents consumption. This is the United States appetite for lamb and mutton in the United States over time. This graph goes on to 2017. The maroon represents imports of lamb and mutton from Australia and New Zealand, primarily Australia. So in the 80s, we saw that as production increased, the blue graph, we were meeting consumption because consumption was increasing. As consumption fell, our domestic production fell. And then in the early 90s, we kind of followed that same scenario as consumption increased, production increased. And then suddenly, consumption began to fall somewhat, and then it kind of leveled out. So in the early 1990s, we saw consumption level out. We saw our domestic production fall drastically, and then at the same time, we saw imports increasing drastically. They converged in 2006. Your sister U.S. sheep industry has earned the distinction of being the first livestock sector of America to be effectively outsourced because of imports. Because from 2006 forward, the United States sheep or lamb and mutton consumer has relied more on imports to satisfy their demand than our beleaguered domestic sheep industry can anymore produce. That's foretelling of our cattle industry if we don't reverse this process. So right now on the table is a U.S.-Mexico-Canada agreement, and you've all been told throughout this entire process from every agricultural trade publication that the best thing that can happen to U.S. cattle producers is if we pass this U.S.-Mexico-Canada agreement, because Canada and Mexico are your most important trading partners, bar none. We are dependent on them for a profitable U.S. cattle industry. So the industry has been telling Congress and President Trump and the entire administration, do no harm. When you renegotiate this agreement, do no harm. We were excited when the Trump administration said they wanted to renegotiate the agreement. We wanted significant changes in the agreement. But the industry told the Trump administration, do no harm, and guess who he listened to? He did not listen to us. And so here's why. It's because they had irrefutable data. The meatpacking lobby beginning in 1992, this graph represents exports of U.S.-produced beef and cattle sold to Canada and Mexico. And you can see in 1992, where NAFTA in 1994 was implemented, we significantly increased our exports of beef and cattle, primarily beef, to Canada and Mexico. There's no question about it. And this is the irrefutable evidence that they brought to the Trump administration and said, here's why you should do no harm. Our exports have grown significantly to these two countries. Don't do anything to disrupt that. But what they didn't tell the Trump administration or anyone else is that trade is a two-way street. It's much like your checkbook with debits and credits. If you only state what your credits are, you're not giving a full picture of the impact of your current financial situation. So with respect to exports, we have significantly increased. The maroon on this graph represents those significantly increased exports. But the blue on this graph on an annual basis represents the imports of the very same commodities we're shipping to Canada and Mexico. And so you can see that the imports have overshadowed our exports every single year through the 25 years of NAFTA. And where I circled the graph happens to be the years of 2014 and 15, when imports from those two countries increased 41% by value. We had a 41% surge of increase of imports from Canada and Mexico from 2013 and 14. A lot of that meat went into cold storage. You all know what happened to your prices after that. So what the Trump administration apparently does not know, he knows this in the auto industry, he knows this in the textile industry, because in the new USMCA, he made reforms for those two industries to recognize the significance and importance of maintaining a high percentage of domestic production so as to support the domestic supply chain for those industries. But he's ignored you completely, and the new USMCA makes absolutely no changes whatsoever to the trade in cattle and beef for your industry. And that's why we cannot support the USMCA, and the administration must do something before we could support it. And what we have asked for is to include country of origin labeling, so at least giving you the ability to compete against this growing tide of imports that are coming into this industry in order to squash any price rally that you experience. I'm showing you this similar graph for the entire world because you've been told how we are a net exporter. That is false, and it's false because when you look at the actual volume of exports, the maroon represents exports to around the world of U.S. beef and cattle. You can see the decline in the middle of the graph. That's in 2004 when the United States detected an imported Canadian cow with BSE in December, and 57 markets closed their borders to the United States. Our exports fell to a 19-year low and then began to recover, but the imports throughout this entire period have overshadowed those exports, meaning we continue to maintain a significant deficit with respect to our international trade. But going back to Canada and Mexico, so the last 4 or 5 years, we have essentially been selling Canada and Mexico $2 billion worth of beef and cattle, and we've been buying from them $4 billion worth of beef and cattle. So we go over to the card tables over here, and we sit down at the card table, and every time I give you $4, you give me 2 back. I give you 4, you give me 2. I give you 4. How long will you play that game? Till I quit? And we thought we had a president that understood that and was going to take action, and it hasn't happened. So my timer says I'm up, George? 5. So well, South Dakota picture. So where do you think consumers want their beef produced? Do they want it here or here in Costa Rica? Because we import beef in Costa Rica that is not now required to be labeled if all it does is go through a US processing plant and get unwrapped and rewrapped. And so let's look at timeline for country of origin labeling, because this is significant. The red circled area represents your feeder calf prices, 550 weight feeder calves based on Oklahoma City data. So the red represents the period in which you had full implementation of country of origin labeling. We were retaining the foreign label on imported product all the way through retail sale, and we were requiring all the beef produced in US beef packing plants to be labeled as to where the animal was born, raised, and slaughtered, meaning consumers had accurate information as to which beef product was exclusively in the United States of America. We start this graph in 2002 when country of origin labeling was first implemented. Expectations were that we would have it implemented relatively quickly within a couple of years. Your feeder calf prices increased some. Then it became clear that the meat packers had regrouped, were fighting, and prevented USDA from implementing the law. We saw our feeder calf prices begin to subside. And then in 2009, the arrow from the bottom going up in the middle of the graph, that was partial implementation of COOL. We were finally at least labeling the imported product to the consumer. Our feeder calf prices began to increase. And then we had the World Trade Organization criticize us, stating that we were discriminated against foreign cattle through our country of origin labeling law, and they issued an edict to the United States. You know, we thought we were a sovereign nation until the WTO told us what we had to do. They said we either had to repeal the law or we had to change the law, and the US Department of Agriculture did something very good. In May of 2013, they did change the law by virtue of changing the regulation that has the force of law, and the new regulation required, beginning in May of 2013, full implementation of COOL, because that's when the beef was required to be labeled as to where the animal was born, raised, and slaughtered, and your prices rose to the highest nominal levels in history, and when they subsided, they were still higher than they were throughout this entire period with one single exception, and after the full repeal of country of origin labeling, your prices fell $61 a hundredweight for a 550 weight calf, and today you're struggling with prices that we had about 8 years ago.